Hey everyone, Alex Late from Tried True Mortgages. Going to be going over what is a mortgage and all the ins and outs that you need to know for getting a mortgage. So we're going to talk about mortgages 101. We're going to talk about some common mistakes when people get mortgages and a lot more. So stay tuned. Alrighty, like I said, this case study is going to be on what is a mortgage, and we'll jump right into it. First, a little bit about the content and what we're going to be discussing. I'm going to be going a little bit about me. If you don't know who I am, a few details there. Second, should I even apply for a mortgage? Third, what is a mortgage? Fourth, some mortgage mistakes to avoid. Five, we're going to go into a real world mortgage scenario. Six, some common mortgage frequently asked questions. Or sorry, six, that's going to be the sixth one. And then seven, the next case study that we'll be doing next week. Okay, so a little bit about me, if you don't know who I am. My name is Alex Late. I'm a mortgage agent in Hamilton, Ontario, Canada, with the Tried and True Mortgages team. I'm a partner on the team, and we're under the Empire Mortgage Group brokerage. I've worked in the financial industry for over 5+ years and have 3 years as a senior financial advisor and 2+ years as a mortgage agent and continuing. Our team, Tried and True Mortgages, has over 50 5-star Google reviews and Facebook reviews if you want to look us up. Like I said, I'm a partner at Tried and True Mortgages, and I've personally helped over 250 clients, whether that be in my senior financial advising days, where I also did mortgages, and I should say, in my mortgage agent days and continuing here. So to begin with the presentation, should I apply for a mortgage? And here are the three most common or main objections that we hear from our clients and things that you should even just be asking yourself before you want to apply. First, the major one is affordability. So we have seen over the past decade or so, home prices, especially in Canada, increase to levels that we've never seen before. And with that, you tend to see mortgage balances increase quite a bit. The reason for this is because most people can't come up with an entire amount of the purchase price. So let's imagine, suppose you were purchasing a home for 500,000. Most people aren't just going to have $500,000 lying around. And this is the reason you would take out a mortgage in the first place. But it also begs the question of affordability and can you actually afford it? So this is something you need to ask yourself. I wrote here, over the last decade, housing prices in Canada have skyrocketed. As a result, mortgage balances have also increased, making it difficult to qualify for a mortgage. A second major objection we tend to see is debt risk. And this is something you should always ask yourself, whether you're taking on a mortgage or any type of credit. But whenever you do take on a mortgage, you are taking on debt, and that debt comes with some inherent risk. So if you have a mortgage, you're going to be obligated to pay. And if you don't pay, the lender or the bank is going to likely foreclose or do a power sale on your home. So having too much debt, having too much leverage, or the term is being over leveraged, definitely comes with some risk associated with it. And you have to be very, very careful that you, first off, you can afford it and then also repay it, which we'll be talking about in the third objection. So I wrote here, for some Canadians, managing mortgage debt can be difficult because of the large debt balances associated with mortgages. The more debt you have, the greater the risk of default. And so, like I said, that also includes other types of debt. But for this presentation, we're going to be talking, or this case study, we're going to be talking about mortgages. And then the third main objection or question you should be asking yourself, can I actually repay this debt? So I can, let's say I can afford the debt and it's not too much of a debt risk to me because I don't have much debt right now. Can I repay it, and will I be comfortable repaying it? So if you're actually able to qualify for the mortgage, you might be able to qualify up to a certain amount, but you have to ask yourself, and you should ask yourself, do I want to be paying that amount? And also, does that amount fit into my budget? And so if you do this, you essentially eliminate any risk of foreclosure or missed payments or power of sale because you've fit into your budget the maximum that you can afford and not the maximum you can actually qualify for. So I wrote here, when times are tough, it's crucial to prioritize mortgage payments to ensure they are never missed, as failing to do so could have serious consequences, such as losing your home. And so that's what I mean by the repayment. You just want to make sure that if you are applying for a mortgage, make sure that you can afford that payment because you don't want to run into one of those situations where your home is now being foreclosed on because you took out too much of a mortgage and can't actually afford the payment. So that third one really goes with the first and second objections as well, but it's just something to bear in mind. Moving on, what actually is a mortgage? So we've talked about some of the objections before you even get into a mortgage. So what is a mortgage? I took this definition right from investopedia.com. They have really good definitions of financial terms and all financial aspects. So according to Investopedia, a mortgage is a type of loan used to purchase or maintain a home, plot of land, or other type of real estate. The borrower agrees to pay the lender over time, typically in a series of regular payments that are divided into principal and interest. The property then serves as collateral to secure the loan. So long story short, a mortgage is a type of loan that is secured by real estate. And for the purposes of this case study, most people are going to be using a mortgage to either purchase a home or refinance their current mortgage on their home. Essentially, with a mortgage, you're going to take out a balance. Let's imagine you take out a $500,000 mortgage, and over the next 25 to 30 years, you're going to pay this mortgage off in installment payments, whether that be monthly, bi-weekly, weekly, and more. There are a couple of other aspects to the mortgage, which I'll get into later in this case study, but there are things that are included in the mortgage, such as interest rate. Interest rate is really just the cost that the lender or bank is charging you for allowing you to borrow that money. There's the amortization, how long it's going to take to pay off the mortgage. And then there are the terms and conditions. So the terms and conditions are, can you add prepayments? Can you change your payment schedule? And so on. When you are getting a mortgage, there are a few things that you really want to avoid, and there are things that you should avoid. So in this slide, I'll discuss mortgage mistakes to avoid. First, when you do go apply for a mortgage, a lot of people make this mistake of picking a bank over a mortgage broker or a mortgage agent like myself. And we think this is a mistake because if you just go to your bank, chances are they'll only be able to offer you average rates in the market and not be as competitive as a mortgage broker would be. And the reason for this is because the bank representative or the bank agent you're working with only has access to what that bank offers. Whereas if you go with a mortgage broker, the mortgage broker will work with multiple different lenders, multiple different banks, and be able to determine, okay, this is your income, this is your credit score, this is your down payment, etc. Here are the banks that are willing to lend to you, and here's the one that gives you the best terms and conditions, the best interest rate, and more. So this is one of the biggest mistakes we tend to see. People going into their local bank where they already have a checking account, savings account, and thinking that's the only place they should look for their mortgage. It's a huge mistake because if you only get an average interest rate and you don't get the lowest interest rate on the market, as well as other terms and conditions of the mortgage, you could really be losing out on thousands of dollars. I like to put it into perspective. You might lose out in interest the amount of a new vehicle or a European trip. You have to really watch out for that because you don't want to miss out on those savings, and you also don't want to set yourself up for failure going into the next 3 to 5 years, depending on what term you end up choosing. So I wrote here, some people prefer working with their bank when applying for a mortgage. Although this can feel comfortable, most times you're missing out on better rates. Absolutely true. Another mistake that we tend to see and what you want to avoid is term risk. So when you are getting a mortgage, you're going to have to decide, and this is for Canadians only, but you're going to have to decide how long you want to lock into your interest rate and the terms and conditions of that mortgage. So generally in Canada, we'll see terms from 1 years all the way up to 5 year, and then some lenders offer 7 and 10 years. If your life circumstances are going to remain the same, there are times when you want to choose a longer term, such as the 5 year or more. In some circumstances where your life is going to be changing in the next even 3 years, you're probably going to want to choose a shorter term. The reason this is such a big risk is because if you end up needing to break your term, especially if you go with a fixed rate mortgage, you're going to have some penalties that you're going to have to pay in order to break the mortgage. After all, the banks have set aside that money for you and are expecting to make a certain amount of money over the term. If you break it early, they're going to charge you a fee to break it early so that they can recoup their costs. So what we wrote here, a major decision when applying for or renewing your mortgage is the type of term you choose. Choosing a fixed or variable term can be detrimental without proper analysis. So not only the term length, but also the type of mortgage. There's two different types. You're going to have a fixed mortgage type and a variable mortgage type. Some people also call variable rate mortgages adjustable rate mortgages. And there's a slight distinction there, but for the purpose of this case study, it's all the same. And so that's something you're going to want to talk with your agent about. Sometimes, unfortunately, when you do go into the bank agent might not necessarily know all the ins and outs of the difference. It might not ask those proper questions to get you in the best term suitable for you. And the last mistake we see often, and the mistake you should avoid, if you currently have a mortgage and you're up for renewal in the next 3 to 5 years, or whenever you're up for renewal, you want to make sure that you go and work with a mortgage broker and shop around, because the bank is going to send you a renewal agreement and expect you to sign it right away. But what we see 9 times out of 10 is that that mortgage renewal agreement is going to have bad rates. And the reason they do this is because they think a lot of people just like the convenience of being able to sign and send the mortgage renewal back. And so they don't necessarily look into the rate or look at rates that they can get elsewhere. And it's more out of a convenience thing that they're signing that mortgage renewal and sending it back right away. Whereas if you go shopping for different rates, you could potentially be saving those thousands of dollars, like I mentioned earlier. You might be saving a trip to Europe just by moving your mortgage to a different lender. This doesn't really, some people might think, well, this might put me at risk because I'm going to have to do all this paperwork, have to do all this application and get to a new lender. When you actually start to look at the process, it's pretty straightforward, especially if your mortgage agent is good and they streamline it for you. And so that's one of the reasons you want to shop at different locations, but also you want to just shop with a mortgage broker because they're going to be able to take your information once and look at your renewal options with multiple different lenders. So I'll just give you an example. I had a client a couple months ago. Their mortgage came up for renewal with their bank, and they had gotten their mortgage quite a while ago. So their interest rate was much lower than the rates in the market today. And the problem that they were going to have was that their payment was going to be outside of their budget now because of the renewal rates that their lender gave them. They came to us. We were able to look at their scenario, take their information, talk to a bunch of different lenders that we have access to. And from there, we were able to determine there's a lot better rates in the market. In the end, we ended up moving them to a different lender. They kept their remaining amortization exactly the same, but their interest rate saved them over $200. The interest rate we were able to get them saved them over $200 per month. $200 is a lot of money. It's your cable bill, it's your phone bill, it's your utility bill. And so in their case, it ended up saving them quite a bit. So what I wrote here, your bank will send you a renewal agreement when your mortgage is up for renewal. Most renewal agreements have unfavorable rates. If you don't shop around at renewal time, you could lose out on lost savings. So just what I mentioned there. So let's jump into a real world mortgage scenario. So this scenario, we are going to be discussing a purchase. So somebody is looking to purchase a home. And in this case, I set the mortgage or the house purchase price at $500,000. So in every single mortgage or purchase scenario, or even refinance, the minimum down payment is 20%, unless you're going to do a default insured mortgage, in which case the minimum down payment is 5%. That'll be in a different case study though, where we discuss default insurance and other costs associated with doing less than 20%. So in a regular scenario where you avoid default insurance, where you avoid any sort of premium, you need to have at least 20% down payment. So in this case, $500,000 purchase price, your down payment would be $100,000. And then your mortgage balance is the 500 minus the 100,000, and your mortgage balance would be 400,000. So suppose we are able to get you an interest rate of 4.99% on your $400,000 mortgage, and your amortization was 25 years. Your monthly mortgage payment would be $2,324.14. A couple notes about this. In this scenario, I didn't state if it was a fixed or a variable rate, but it would be more likely a fixed in this case with the current interest rates. At the time that you're watching this video, interest rates might have changed and variable interest rates might be more favorable. It just depends when you're watching. Another thing to factor in, because there is 20% down payment, you can technically increase this amortization up to 30 years. So amortization is just a fancy word for how long it's going to take for you to pay off your mortgage. Most people, when they get a new mortgage, when it's their first mortgage or they're even refinancing into an entirely new mortgage, they will set up a 25-year or 30-year amortization. So a 25-year is standard, 30-year, what that does for you, it's going to lower your monthly payment. But generally speaking, with a longer amortization, the banks put a premium on the interest rate. So your interest rate may have been 4.99% on a 25-year amortization, but the interest rate on a 30-year amortization may be 5.25% or 5.19%, somewhere in that ballpark. So that's a real world mortgage scenario of purchase price, down payment, what your mortgage balance ends up being, and interest rate, amortization, and then your monthly payment. A couple things, one more thing I want to note here is your monthly payment can be changed to weekly, accelerated biweekly, weekly, accelerated weekly, biweekly, accelerated biweekly, and even semi-monthly. These are all just different payment schedules about for how often you're going to make a payment to your mortgage. Monthly, obviously, as it states, is going to be once a month. Biweekly is going to be every other week. Weekly is going to be every week. And so there are pros and cons to choosing different payment schedules. And that's something you would have to discuss with your mortgage advisor at the time, because monthly might be proper for some people, might not be proper for others, just based on when people get paid and their budgeting on a monthly basis. Some frequently asked questions. So here are probably the three most common questions that we receive as mortgage agents. First, I touched on this a little bit earlier, but should I go with a fixed or variable? Or what I wrote here, what type of mortgage should I take, a fixed or variable term? And the answer to this is not a black and white answer. It's actually a case-by-case analysis of your present circumstances and where you're going to be in 3 to 5 years. So with Tried and True Mortgages, we actually have an interest rate flow chart where we walk you through multiple different steps and determine where you are going to end up. And this flow chart can be found on our Instagram, Facebook as well. And so your mortgage agent or bank agent even should be walking you through some sort of questionnaire to see what's going to be best. And so some of these questions are going to be things like, are you okay with a payment change? Are you okay with a payment increase? What are your plans in the next 3 to 5 years? Are you looking to move? Are you looking to refinance? Is there a financial interest rate benefit to go with the variable over the fixed in the next 5 years? And where are interest rates heading? So we have this all on our flow chart. and it's a yes, no type of answer where we can walk through the flowchart with our clients and then help them decide. So that's the first question we get all the time. And like I said, there's no black or white answer, but there is a set of questions you should be asking yourself every single time. Following up on that, the second most common question we get is, what is the best term length and when are interest rates changing? So again, the best term length is going to be different for you than it is for me. If I'm not moving in the next 3 to 5 years and I can get a lower interest rate with a longer term, I should probably go with that term. However, if I know I'm going to be moving in the next year or 2 years, you might as well avoid any prepayment penalties or fees that might be associated with breaking your mortgage early. So the term length is really going to be dependent on where you think you're going to be. Some people, for example, I know we have some clients that are nurses and they do travel nursing. And so they're moving around quite a bit, especially in Canada, across the country. Being in a longer term, a lot of times for them doesn't make sense. Whereas somebody who's in a tenured job at a location that doesn't move, the 3 or 5 year option is probably going to be better, or even 4 year option in that case. So really analyze where you're going to be, and you're going to have to ask yourself some difficult questions. Where am I going to be in the next 3 to 5 years? Am I going to be changing jobs? Are my life circumstances going to change? And so on. And then lastly, the third most common question we hear about mortgages is, why can't I qualify for a larger mortgage? And so this is less to do with the actual mortgage itself and more to do with your financial circumstances. And the answer is, again, case by case. Every single person is going to qualify for a different amount of mortgage. And that's because the amount of income you earn, your credit score, your down payment, the property's home equity are all going to factor into how much mortgage you can qualify for. I'm actually going to be doing a case study next week, which I'll get into later in this case study, about how to actually qualify for a mortgage. And we'll be talking about your maximum approval and maximum purchase price in that case study. But this question is a good question. But in essence, it's going to depend on quite a few different things. So like I said, your income, credit score, etc. That really brings us to the end of this case study. Thank you very much for watching. Much appreciated. If you have any questions or comments, don't hesitate to leave a comment below or follow us or reach us on our social media or even email. You can find it on our website. The next case study is going to be on how do I qualify for a mortgage. So I'm going to touch on how to qualify, what you need to qualify, income documents, down payment information, and so on. And we'll also be getting into that last question there about maximum affordability and why some people can qualify for higher mortgages, whereas some people can't. So if you enjoyed this, please give it a like and thumbs up if you can. And if you have any questions, like I said before, or comments, we try to respond to everything as soon as possible. So thanks again and have a great day. Bye-bye.